Good afternoon, everyone, and welcome to the third installment of our new webinar series, FI Live. My name is Leslie Mondesir, and I am the Marketing and Member Solutions Manager here at the bank, and I am joined by Drew Simmons, our Oklahoma Regional Account Manager. A few housekeeping items. This is being recorded. A copy of the slides and a replay link will be sent out following today's webinar. We will be doing polling questions. So those of you that are looking for CPE credits, make sure you are engaged with the poll questions so we make sure those can be awarded to you. We will get one CPE credit for your participation today. We will get your CPE certification credits sent to you also as well. If you do have questions, please feel free to use the Q&A feature there at the bottom of your screen, and we will do the best we can to get those answered during today's session. And then if we need to do some follow-up afterwards, we can do that as well. And with that, we will kind of turn to our first polling question on the topics that we have for today: economic update, trends from some call report data, talk about some funding strategies, advanced products. We have a guest with us today, Ryan Gilliland. He will give us an update about Capitol Hill. He is our government and industry relations. And then we'll have a quick update on our HCD community and grant programs.
Okay.
Go to, yep.
So this is our first polling question, or questions rather, two of them. I'll give some time for those to load on the screen. First one is just, do you need CPE credit for today, yes or no? Second one, which section of the webinar today are you most excited to learn about? Market and economic update, peer analysis and member trends, funding strategies and considerations, and a update on the home loan bank system as a whole. So just make your selections there. We'll wait a little bit, let those filter in, and we'll have those memorialized. We won't need to share these first two poll questions today, but for the rest of the webinar, we will be sharing everyone's responses so you can kind of get a gauge of what the room's thinking with those answers. Okay, I'm going to go ahead and close the poll now. Appreciate it. Okay. Looks like a good chunk of you do need the CPE credit for today, so we'll make sure to get that out to you. Okay, with that, I'm going to go ahead and kick things off with an update with the economy. We talked about this last time that, there's obviously a lot has happened since our last webinar. We have the election. We had another Fed rate decision. And we've got all of these implications from a new administration moving into the White House from President-elect Trump's victory in November. So we'll talk a lot about that. Ryan has a lot to talk about when it comes to the implications of the election, not only the presidential election, but the shift in the Senate, the House, and some of the policies that might have a direct impact on the federal home loan bank system as a whole. So we'll talk about that a little bit. But first, let's just take a step back and look at the macroeconomy. Inflation does continue to improve. We are seeing a little lower numbers when it comes to the Fed's preferred method of inflation, core PCE. You can see that in the middle of your screen there, a drop to 2.7% since our last webinar. GDP has also come down a touch, 2.8%. And above that, I just wanted to put it to the room, start thinking about, do you have any sort of sense or feeling that maybe the Fed might consider a pause or slowing down of their rate cuts? Clearly, they cut in their meeting just after the election, and right now there are strong odds that they will cut again in December, but not as strong as they really have been for the last two rate cuts. Right. Core CPI is also a little up. There's a little bit of a disconnect between that and PCE. Most of that has to do with shelter. We talked a little bit about that in the webinar before last, not the last webinar, but the webinar before last, when we talked about, some of the shelter components that are embedded in PCE and CPI and some of the differences there. The owner equivalent rent, for example, is lagging quite a bit to that of what we're actually seeing in more real-time data, other statistical measures that we see through Redfin and Zillow and some of these a little bit more on the market type data sets that are reported from those folks. From an unemployment standpoint, unemployment rate looks good, but we're seeing some softening insofar as the labor market. Today, we had continuing claims that came up a touch over survey, initial claims just a touch below, but certainly not seeing just this massive improvement in the labor market. It's just sort of holding steady these last few prints. As far as the housing market, clearly that's the biggest, I think, drag when it comes to inflation. When you strip out, we talked about this before, when you strip out shelter out of either CPI or PCE, the Fed has effectively achieved their 2% target. So that's the sort of the stickiness that we're seeing, and that's not helped by low supply in the housing market. But HPI, house, improvement in pricing overall, it continues to stay about that 5.73% year over year growth. So right now, it's holding steady. Pending home sales did improve a bit, 2.2%. But the kind of the chart of the day I wanted to talk about here is, no matter who took over the White House, no matter really what happened in the election, is the administration was taking on a massive amount of federal debt. You can see that in that chart over here to the right, where we've just seen this skyrocketing of debt, especially following the '08 crisis. Then we had COVID, massive amounts of stimulus in the system. And then here we are today at record levels of federal debt. And that is also shared by businesses and consumers. So really the debt bubble that I think a lot of folks are starting to talk about is a very real and present danger. And if we really kind of put on our Econ 101 hat, that is disinflationary by the very nature, right? Your spending power. Now we're going to see probably a lot of fits and starts in various indices, not only in the bond market, but then in the stock market. We've already seen some consternation there. It's a little difficult to find footing here until we really know what policies are going to be prioritized. We have a general idea of that. I know Ryan's going to touch on that a little later. But the reality is, we're still in very uncertain times when it comes to what does this administration, what does the economy look like under this new administration, and how quickly are those policies going to impact the capital markets? Certainly, there was some feeling initially that stocks liked it, bonds did not. But then we've seen a reversal of that. So there's clearly some consternation, and that won't change anytime soon. But here's what we're seeing so far. Before I get to that, though, let's go ahead and open up the next poll question when it comes to the Fed's future rate cuts. Do you think, I'm going to wait for this to pop open here, but you can see in the slide anyway what your options will be once we get that loaded here. Do you think the Fed is going to have maybe 4% plus, meaning that they're really not going to do much more from here? Do you think the terminal low in the Fed funds rate will be more somewhere between 3 to 4%, 2 to 3%, 1 to 2%, or 0 to 1% effectively, eventually landing at a ZIRP policy note, zero interest rate policies that they've had over the last two recessions, clearly. So make your answers there. Again, do you think the terminal rate really won't be much different than what we're seeing today at 4% plus, 3 to 4, 2 to 3, 1 to 2, or in that ZIRP world that I personally don't want to see us go back to, but who knows? Okay, so those have been closed here. Okay, this is an interesting trend here. We're seeing about 18% of you think that this is it, that maybe the new administration's policies are such that the Fed really doesn't have much need to to lower the Fed funds rate much more from here, not materially. Most of you though are in the 3 to 4% camp. So it's interesting that 61% of you do not feel that the Fed will get down to that 2% handle that they talk a lot about.
And over the last couple months or last month or so, that's come up from sub 3 to even creeping up to the mid 3s on where that landing point might be.
And I know we closed the poll there, but those last two options, it looked like there was a decent chunk that maybe thought we'd get to that 1 to 2% handle, and just a handful of you might believe we're headed back to ZIRP world. So very interesting there. Okay. So let's talk about Fed funds futures for just next month and looking on to the rest of 2025. 60% chance. I pulled this chart midweek last week. 61% chance of a cut come the December meeting. Now, normally, we're riding right up onto Thanksgiving. We'll be right into December, and just a couple of weeks later, they're going to meet. Normally, in prior, whether it's Fed hikes or cuts, normally that percentage is upwards of 85, 90%. When you're inside of a month away, we're pretty short turnaround there, especially with the holidays and market closures. So that in of itself, I think, speaks to a lot of the same uncertainty that the room felt, right? Where you saw that your responses are in there. Some of you kind of are in the camp of, hey, there's not much more they can cut, honestly. And others are kind of about mid-range. They might be able to pull off 2 to 3 more cuts. And then there are some of you that think they can maybe do, 5 or 6. And that would, of course, translate into something closer to that 2% handle that the Fed ideally would want, right? I mean, that 2%, there's nothing really magical about it. It's just, we want inflation. We just don't want disinflation and deflation, and we don't want the type of inflation that we've had for these last few years. So interesting to see that. So really, what is the implication for the rate markets in general? And this is a good chart that was covered by David Rosenberg. Some of you have seen him present at various conferences across the country. He's got some very, very good insight, great economist, and he's basically showing here in this chart the correlation of the 10-year Treasury note and these other indicators, whether it's the Fed funds rate, core CPI inflation, wages, headline CPI, unemployment rate, capacity utilization, real GDP, fiscal policy, and the US dollar. So, the story he's trying to tell here is the correlation of what the Fed does is it's very, very strong to how the 10-year and Fed funds rate respond to each other through rate cuts or rate hikes, doesn't matter. What's, I think, shocking to a lot of people is this 20% correlation to fiscal policy. So, regardless of what Trump does, and there's been a lot of talk about tariffs and how that might bring back some inflation. It's certainly reasonable to assume that will have some inflationary sort of unintended consequences. There's sometimes situations where tariffs have worked out great. Toyota is a great example here for the national economy. When they placed a tariff on pickup trucks, it took years in the making, but eventually Toyota decided they're going to manufacture their pickup trucks here in the United States. In fact, we're having our system sales meeting in San Antonio. That's right where Toyota makes your Tundras and Tacomas and things that you see driving around the road. So, but this isn't an overnight thing, right? That took probably nearly a decade. I think it was Carter it was the Carter administration that imposed those initial tariffs, and it took many, many years for Toyota to finally respond to that. So, but the bottom line is what we're really focused on is the Fed. What the Fed is going to do going forward will pretty much be the best indication as to what response there will be with Treasury yields, and that of course affects us at the Home Loan Bank as well as you for your funding needs going forward. So let's just, he also showed this chart, Rosenberg did, looking at the last 14 Fed hikes, 11 ended up landing in recession. So you're seeing those events here to the right where it did or did not land in a recession for the last 14 prior Fed hikes. 11 of them landed in recession. And then over here to the left, you can see the months from the last Fed hike to the start of the next recession. Okay, so on average, it's been about 29 months, a little over 2 years. We're already beyond that here. We've had some unprecedented sort of market moves over these last few years. So certainly we might be an outlier this time, but we're pretty tightly correlated there so far, depending on how much more long in the tooth we have before we officially start into a next recession. Talking about the yield curve, we covered this last time. I've charted three different moments in time where we're looking at the Treasury yield curve here. The green solid line right there in the middle is where we stand as of last week. The green dashed line is where we were at the beginning of the year in January. And then the yellow dotted line here is where we were in June. So you can clearly see we are in a bull steepening. We've gone, about 80 points down in effectively overnight money, 1 month money. We've gone up 50 basis points in the interim part of the curve, the 5-year part of the curve. And then, the long bonds, the 20 and 30-year treasuries are up about 60 basis points. But we are still inverted. Make no mistake. We're just not nearly as inverted. So the bull steepening is happening, sort of, right? Because the bull steepening is certainly happening on the short end, where rates are falling significantly, but the long end is increasing. So that's actually helping it steepen a little bit more, which is a good thing. But we still are in an inverted curve all the way out to the 15-year maturity. You can see that right here, where the 1 month Treasury bill is trading relative to the 15-year part of that curve is where it starts to break even. So we are still inverted in most of the curve, but with other types of inflection points like the 2s, 10s is not inverted. And that's what we see here. So last time we talked, I believe it was in August during our last meeting, we were still inverted. We've been inverted for a very, very, very long time. I could take this chart back even further than the November 2023 starting point that you see here on the screen, but a very, very long time that we've been inverted in most of all tenors across the curve. And of course, the 10s 2 spread is the most commonly talked about. But really, since September, we've been positive. It's had some consternation here. You can see that just kind of bouncing up and down, got as wide as 20, let's just say 23, 24 basis points, and currently around 10 to 13 basis points as we stand today. The 10-year Treasury rallied pretty strong, for, really since the high point in mid 2023, kind of fell a good chunk of it in the latter part of the year there in 23. Started to sell off as we started the year this year, but really since about the beginning of the summer, the Treasury market had rallied. I think a lot of that had to do with the switch that happened with Biden to Kamala. There was some, questions. Is a more sort of, fresh new candidate in the mix really going to get some interest with new voters, younger candidate, all those things. Clearly, that started to change once the election hit, right? So right now, we're kind of probably stuck in this range-bound market. I wouldn't expect really the 10-year Treasury, especially to get any lower than 4 and probably any higher than 4.8. So we might be in a kind of 50 to 80 basis points range until we get a little bit more clarity as to the policies, not only from the new administration, the Trump administration, but also, of course, most importantly, as that first slide talking about the correlation of the Fed moves. What does the Fed do in December? What are they going to do in January? Looking ahead as to where we think that they're going to officially be done with these rate cuts. They're barely scratching the surface as it is, so it remains to be seen. GDP, we talked about this a little bit, really hasn't moved much, inching a little bit lower. But I think, this when you're talking about GDP nationally and even globally for that matter, the inhibitor in the room is the debt problem. And again, either administration, wouldn't matter if Kamala won or Trump's win, they were inheriting a sizable amount of debt that's naturally disinflationary. Core PCE came in at 2.7%, an improvement, nearing that 2% mark. Again, I can't stress it enough. You start stripping out owners' equivalent rents and the shelter inputs, and sure enough, we are at that 2% level. But we're only 70 basis points away there. So inflation, you can't argue that it hasn't significantly come down, and we'll see if anything changes going forward as it results to some of these tariffs that are being talked about with the Trump administration. Unemployment rate, like I said, the unemployment rate itself is looking fine. The question is just some of the more leading indicators in the employment picture for the United States right now. All the lagging indicators, all the coincident indicators have been strong, and the leading indicators are moving negative. So there's been some talk from analysts and economists that, is the Fed even paying attention right now to any of these leading indicators? Because it doesn't feel that way. But that might start to shift as they see more tangible numbers in the labor market going forward. This is an interesting chart that was also brought up by Rosenberg's recent presentation for a conference down at Scottsdale, and it really just is highlighting, maybe some of the irrational exuberance, as Greenspan used to say, in the equities market. Right now, for the first time in history, passive index funds exceed more than 50% of the market. So this is just a chart looking at your active funds relative to your passive funds. So does that mean that there are a lot of sleepy investors out there kind of asleep at the wheel? Just, hey, I'll just put my money in the S&P and it's been doing great. I'll continue to do that going forward, as opposed to the active. And you can kind of see they've had much more pullback after a peak there at the beginning of this sort of last 2-3 year cycle. And yet passive investors have continued to notch up higher, in the first time that they've actually exceeded their representation in the market relative to active investors. So I'm not an equities guy. I couldn't tell you whether or not that's a major red flag or not, but it certainly tells us something about the differences between folks that are just kind of putting their money in the markets generally, as opposed to those actively managed funds. I mentioned this earlier, the S&P has reversed the initial election rally. So stocks really liked it, and then they didn't. So welcome to the show. I mean, I think that there's going to be quite a bit of confusion as to where stocks are headed. And certainly if you're a rate buyer, then you probably will like bonds right now way over stock dividends. The disparity between stock dividends right now and the bond market is quite high. So you might consider that going forward when you're talking about your investments and what to do in the investment portfolio. Okay, let's go ahead and jump into a poll question here, and we'll load that here in just a second. But we asked this before, we'll share it again. What's the biggest concern you have for your local economy? Is it A, inflation? The next option there, housing affordability, unemployment, or rising delinquencies? When we've had our first webinar, just as a reminder, we, first quarter of the year, the big concern was inflation. Most of you were concerned with inflation. Always a good chunk concerned about housing affordability. That's certainly at the top of our list here at the Home Loan Bank. Unemployment, not so much. But what was kind of surprising is during our second webinar of the year, the lion's share of you actually picked delinquencies. So
we're mixed.
We're back to a pretty good mix here. Looks like many of you, if you answered before, it's hard to kind of say who is attending back to back, but the largest percentage has officially shifted to housing affordability. So we started the year with the biggest concern being inflation. We moved to rising delinquencies. Those are still in the top three concerns here for you. Very few of you are concerned about the unemployment picture, but certainly there's been a notable shift over to housing affordability. So we at the Home Loan Bank wish we had a crystal ball and a magic button to fix housing affordability, and we certainly have many, many programs to help sort of alleviate some of the concerns, especially when it comes to first-time home buyers. And we've rolled out new products. So, keep your ear to the ground with us. We're doing our best to roll out programs and distribute funds to help to that end. And if you have any ideas, by all means, share those with us. If you sometimes you got to get creative these days when it comes to getting folks in homes. Okay, I'm going to go ahead and close out the poll there and move it over to Leslie, who will talk about member financial trends.
Thank you, Drew, for the update on what's going on in the market, some of the indicators that we all tend to keep an eye on, along with the Fed. And we'll kind of shift into kind of what we're seeing with the balance sheet and income statement and third quarter financials for members, both banks and credit unions. Some takeaways that we have from the balance sheet. Liquidity positions kind of mixed across our bank and credit unions, also based on size as well. Loan growth that we'll see here on the next slide definitely slowed across all segments during the quarter. The need for wholesale funding, options outside of your traditional core deposits, that remains elevated as well to help fill liquidity and some funding needs. Also related to that, just the deposit gathering environment remains a challenge, and holding on to those deposits that your institution holds is continues to be top of mind. Provision expense, especially for our credit unions, it has accelerated throughout the year. Reserve mode is certainly underway there. A little bit more minimal for our bank members. But net charge-offs, those continue to grow across all institutions, specifically at larger institutions that we've seen. Equity positions are solid. Tangible positions, they've benefited from the move in interest rates over the last quarter from where they were probably to over the year before that. So we'll dig into the major line items, look quarter over quarter on what changes or shifts we've seen in the mix on both the balance or both the asset side and the liability side. For our bank members, you're going to be on the top line here. Credit unions are on the bottom, use of funds on the left side, source of funds on the right. You can see there that loan growth, the dark blue bars for both banks and credit unions slowed in the third quarter. Loan growth for banks was concentrated in CRE, saw some solid growth there, along with 1 to 4 family and multifamily lending. Smaller banks, they posted stronger loan growth than their larger peers. On the credit union side, loan growth was concentrated in HELOCs and commercial lending. So we saw the commercial lending on both for both institution types on a median basis. So these are in aggregates for each institution type. On a median basis, our larger credit unions posted minimal growth here, while smaller credit unions saw some contraction in their loan portfolios. On the funding side, liability side of the balance sheet, continued to see that shift into maturity accounts, retail CDs, share certificates, non-maturity deposits continue to have some pressure there for those types of deposits. Borrowings did decline for our members. Some of that's related to BTFP. Also advances, it's kind of a mix across members. Use remains elevated and definitely a source of funding that continues to be used. If we're going to go to the next slide, and we're going to shift to a poll question. We're going to look at both sides of the balance sheet here again. What are your deposit growth expectations for 2025 is the first question. And then the second question is those use of funds in the next 12 to 18 months. Are we looking to build some more liquidity into cash, maybe invest in some securities and bonds, continue to fund some loan growth, or kind of no change in what you're currently strategies you're currently working on. Last quarter, we did ask about competition on the deposit front. And kind of as expected, and I'm sure we hear from members and you're experiencing yourselves, that deposit composition just continues to remain pretty heightened. All right, so deposit growth, minimal growth. So again, that environment just continues to be challenging. We did see larger members see more deposit growth, but again, that comes at a cost. And some with moderate growth here. Nice little curve. And then for the second question, looks like majority of you are looking at growing the loan portfolio. And we have heard that from members that loan growth probably minimal, certainly positive, continuing to fund some loans and be busy on that front, which is in line with what we saw last quarter with our polling question on loan growth expectations, looking out into 2025. So we'll close that polling question and move on. Share deposit composition. You can see there on the left, the top line are banks, bottom line credit unions, and we look at the shift in that we've seen through this cycle from non-maturity accounts into maturity accounts. So the gray lines there at the bottom, those are going to be your share certificates, CD, maturity accounts, your higher cost accounts, generally speaking, except for it's maybe some high yield money market or high yield savings accounts. And we've returned to that pre-pandemic, pre-COVID mix, if not shifted past that, especially for credit unions down at the bottom. We're still seeing that trend. It has moderated some, but we'll see if that continues as we move through now into this pivot into a falling rate environment. On the right, we look at liquidity and wholesale funding versus Fed funds rate. The blue line is going to be liquidity. The gray line is going to be wholesale funding utilization. And then the dotted line there for reference is what the Fed fund history over the past 20 to 25 years. And then the yellow shading that you will see here on a few slides that follow relate to the rate environment that we have started to move into, a falling rate environment. And we kind of look at the trends from what we saw historically through prior cycles versus where we are at today. Liquidity build is not quite happening, at least for banks. Credit unions have had a few quarters of some liquidity build that has retreated over the past 2 quarters, and you can see that on the blue line in the bottom right-hand corner. But if you look just at the blue line before the yellow shading in prior cycles, liquidity bottoms before rates fall, and then it begins to build. In credit unions, they tend to trough in quarters before banks do. We'll see kind of how this plays out. Is this cycle, is it different than maybe the past cycles where security portfolios today remain more underwater than they were in prior cycles? And that we'll see kind of how what happens there as we transition through this new rate cycle. Wholesale funding use remains elevated, not just in terms of dollars, but also in the number of members we see using wholesale funding. That's multiple sources of wholesale funding, advances, brokered deposits, both. We're seeing historically high numbers of members using multiple sources. And you can see credit unions over the last 25, 23 years, more credit unions are relying on wholesale funding to fund that loan growth and fill those funding gaps. All right, now we'll move into kind of the earnings side, what impact that, what we're seeing on the balance sheet side, how that's impacting, and the rate environment is impacting earnings. After facing some margin compression for many quarters. We've seen some recent improvement for our bank members over the last couple quarters. Credit unions, that margin expansion has continued. We saw in the third quarter positive trends with over 60% of our banks and credit unions. They've seen some margin expansion. You can see that on the left-hand side. And then on the right are the change in yields and costs for our bank members since prior to our last rate cycle. So beginning of 2019, before rates fell to where we are today. And for banks, asset yields have fallen quicker than funding costs as we in the prior cycle down. We'll see if this trend repeats, especially as CRE loans come due and they look to reprice. We've heard from members recently that they kind of hope the belly of curve kind of stays elevated where it's at through the next 12 to 18 months as some of these loans adjust and reprice, and they'd like to keep some of the yield there on assets, and then as the rates fall, hopefully to get some relief there on the funding side. But we'll see if prior cycle patterns are followed again, or if this cycle might be a little bit different. We talked last quarter about upcoming term maturities and the pressure that's going to have on funding costs. A lot of the term maturities, CDs, as well as wholesale funding, those terms have generally been pretty short. Along with we've had the shift in funding composition where we're with greater reliance on term funding as well. With our bank members, 87% of retail CDs maturing within a year. Same on the credit union side. Those trends have been the same, along with wholesale funding, more so for banks, the use of brokered deposits, nearly all of it is short term. That's a big dollar amount that's going to be facing some repricing if that funding is still needed. Now, we've heard also from members that might need to go through a couple cycles of these term maturities coming due before they see the relief in funding costs. So as these maturities are happening now through the next few months, we'll need to reprice to maybe keep those deposits over the next few months. And then if the Fed continues to move down, maybe in that next repricing cycle can get some relief on the funding side. On the right, we do look at the cost of funding, shares and deposits versus Fed funds rate over the last few cycles. Betas this go around were quite a bit higher for banks compared to the prior cycles. And I know there's the eagerness to move them down as can to get some relief. Larger institutions have had the higher betas than the smaller institutions that we've talked about before. All right. And then we looked at here with that wall of maturities that are coming up, especially on the retail CD side. We use S&P Global to look at deposit pricing and those trends, kind of what those products for the shorter term CDs. And here we can see that they remain elevated. We haven't really seen decrease in funding those costs for CDs since the Fed has started reducing rates on the short end. We'll be sending these slides out so you can kind of look more into the detail of these slides. But we also do look at, these are all the branches, financial institutions, banks, credit unions, whether they're headquartered here or not, and what those pricing trends have been on a weekly basis going back to 2015. And you can see the difference between in-district institutions versus out-of-district that have branches here. I'll touch quickly here on the credit side, and asset quality continues to remain on solid footing, normalizing towards pre-COVID levels. Like I mentioned earlier, credit unions there on the bottom right, the solid line, reserve positions have been growing as provisions have been active in provisioning, so increasing those reserve levels. Credit unions have seen a little bit more uptick in non-performing assets for the consumer facing that consumer stress for a lot of credit unions. And we have one final poll question here related to financial trends. Over the past 3 months, how have your institution's underwriting standards changed? We're going to look at 3 different line items there for the loan portfolio related to commercial, consumer, and ag loans. Give that a few seconds. And then you can answer the consumer loans, because if you're a auto lending or credit cards, kind of both be lumped in there. We can get the results if we've had response. You see, remain basically unchanged for CRE, and that aligns well with the senior lending survey, the last one that came out from the Fed. Definitely saw mostly remained unchanged, and with a lean towards tightening. So that's consistent with what was in that survey. Probably across the board. That's what that looks like. All right, so we are going to wrap up kind of the trends, and like I've mentioned, looking ahead into 2024 and turning into 2025, kind of the topics that remain in focus, along with, we could add to this list maybe geopolitical issues and macro economic, that those continue to be present. Gonna shift slightly here into funding strategies and kind of some advanced products and other products that we have here at the bank to help support your funding needs and support liquidity. On Monday, we announced that we were shortening the SOFR terms for the adjustable advance. We now offer a 1 month and 2 month SOFR advance. Previously, that was 3 months was our shortest term, up to 10 years. We also have call option with adjustable rate advances that is available, a term of 1 to 5 years for those. We've talked about the SOFR advance before. It was also in the email you received today from your account manager, kind of highlighting the product and how it can help potentially benefit your institution if that structure support your funding activities there. And then moving, some considerations for the evolving rate outlook. It's certainly changed over the last few months. It continues to evolve. Soft landing, hard landing, higher for longer. There's definitely you hear some cautious speak from the Fed president on pausing or following the data and being cautious to cut too quickly. Or do we need to pause? It's evolving. And then just taking into consideration as you're looking at your funding needs, your liquidity needs, what are your balance sheet pain points? And then how does that fit with these differing rate scenarios, and how can so various products that we offer help to fill those gaps for you? Specifically bullet advance, SOFR adjustable, the puttable that we mentioned here, bullet advances. They may provide, if you need funding opportunities to extend these rates that you can get on the bullets, they do capture priced in rate cuts. SOFR adjustable, the benefit, it reprices daily with market rates, but does have some term liquidity benefits too associated with it. Puttable advances, it provides some margin relief. You get some immediate cost savings, and it's a cushion for rates to move lower. Puttable advances, they might be more favorable in the soft landing scenario where deposit rates may lag on the way down. So complement your deposit portfolio a bit. And then one poll question related to funding. Where are you concentrating your funding needs? Are we staying short? Kind of a medium term, 12 to 60 months, longer term needs greater than 60, a blend thereof, or not borrowing here in the near future? And then what types of funding structures are you evaluating? those that might have a call or put feature, a variable rate structure, fixed rate, a blend, or again, not applicable and not borrowing now or in the near future. Once we've had a few seconds here, we will see what those results look like. Staying short. I think Drew's probably heard that from members also. Staying short. We have had a lot of members that have kind of transitioned BTFP funding. And when they've gone out of BTFP, they've moved that over to advances, but staying short, usually in the OLOC to provide a little bit of flexibility on the need and how long those funds are outstanding, and then medium term or a blend of terms, and then features, variable rate, and then blend of structures. Great. All right. And then we talked about these few different advanced types and the structures and features. And we mentioned this last time and thought we would just share it again. Our funding strategy illustrations that the account managers can work with you on, where you can input assumptions for market rate movements and how that might impact some variable rate funding versus taking down some fixed funding. So we do have that tool available for you, and we can run as many scenarios as you would like. Hard landing, soft landing, higher for longer. It's kind of limitless on what we can put together to tailor to your institution. Also, something to keep in mind is utilizing marginal cost analytics, especially with the upcoming wave of maturities, both wholesale funding and on the retail side. And then some deposit strategy considerations is doing some research, evaluating the composition of that funding, looking and rate sensitivity of those depositors, knowing the competition. We spend a lot of time here at the bank looking at data and understand what's going on, who are the members with the CDs, how rate sensitive are they, can they roll into a more go from high rate to maybe more standard rate, especially with specials. We do have a tool that is available to help you analyze different scenarios and strategies. On the next slide, we won't go through it, but it does provide a description of the tool that we have and how it can be used to help evaluate different pricing strategies. And then we did want to highlight our rate sheet. If you don't receive that today, you can give Lending a call or reach out to your account manager to sign up for daily rate indications. That does list all the products we've talked about today, along with a few others. And then not a deposit or a advanced product, but another product that we do offer that we haven't spent much time on is letters of credit. We do historically see an influx of public funds expected in the fourth quarter. With liquidity still being pretty tight, letters of credit may be an option for your institution to consider to help improve those liquidity ratios by using the loan collateral that you have pledged with us. Kind of put that to use, kind of unpledge some securities, improve some metrics there on the related to liquidity. And we're here. We have a lot of different provide funding solutions that can be tailored to meet your balance sheet needs through various structures and features. We also have the funding strategy tool we just talked about to help manage the liability side of the balance sheet and the cost of funding. And so with that, we are going to turn it over to Ryan Gilliland is joining us. He's the Director of Government and Industry Relations. He spends lots of time in Washington, D.C., and works along with the system as well. And so, Ryan, we will turn it over to you to provide us an update on Capitol Hill.
Thank you very much. I appreciate it. I've been at the bank going on 9 years now, so it's come full circle. Trump was elected the first time I got here, and now here we are again. So it's been an interesting time, interesting phase. Certainly this cycle has been very entertaining at minimum. But above all, it's nice just to have certainty and there were obviously a number of different scenarios we could have encountered as a result of the election. I think a lot of folks probably contemplated some sort of mixed government, knowing that the Senate was sort of the low-hanging fruit in terms of what Republicans would be able to gain control of. But to get all three chambers, I think, was somewhat of a surprise. And it's still a tight margin in the House. That's something to keep in mind. With a margin that tight in the House, there's always going to be some room for obviously negotiation and variance. And there's not going to be that lockstep mandate that some people have presumed early on. But again, just to have the certainty of who's going to be holding gavels, how appointments are going to flow through, is a real sea change from what we saw in 2016. And I'll kind of start there, because that's one thing I think as you look back on 2016, the Trump administration got out of the chute. It took a while before you heard about landing teams making it to various agencies. It took a while for some of those appointments to roll out, and then you had a number of them turn over. And so I think for the Trump administration, there were a lot of lessons learned. I say that now recognizing Mr. Gates has apparently resigned this afternoon. His term or his appointment and nomination to the Department of Judiciary has ended already. So I think there's obviously going to be fits and starts. There's obviously going to be some appointments that were ready to go in the can and came out within a week. But I think the fact that nobody's been appointed to Treasury yet is a good indicator of kind of what Drew was talking about, in that Treasury is a really important one in terms of financial services, obviously. And it's going to really kind of dictate terms on a number of these issues. So that'll be revealing when we finally get down to the bottom line on that one. With respect to a lot of these other things, again, we've only got a few minutes today, so we're not going to be able to walk through each one of the different policies that Drew's discussed and that will really have an impact on our day-to-day, certainly at the bank, but also yours as well, as we try to gather information on where the markets are going to head. But I'm always reminded of a quote that was written in 2019 by a journalist named Selena Zito, and she, in speaking about Trump, said, "Take the president seriously, but not literally." And I think that's good advice, certainly as you're trying to predict where the markets go, and maybe as you're trying to determine where some of this is going to shake out. Not that that makes things any easier, because on something like tariffs, to a certain extent, he's playing a game. He's setting up he's establishing a position to negotiate. And he's always had this sort of signature style that relies on, he's kind of like a pitcher that's willing to go up and in on a batter all the time, or, he's sort of effectively wild sometimes. And so you can know where he's heading generally, but the way he gets there sometimes is very difficult to predict, very nonlinear. So a few things, I go back to Donald Rumsfeld used to talk about the known knowns and the known unknowns. And I always enjoyed that speech, but that's one way to think about what we've got heading into this new Congress and into 2025. I think on known knowns, one of the things I would start with is the CRA. That's the Congressional Review Act. That's the mechanism that Congress can use to uninstall rules that had been promulgated by previous administrations. You've got 60 legislative working days to uninstall those. So legislative working days is the key there. That is functionally a pretty generous amount of time. So I've seen a number of different projections, but a lot of folks presume that means some of these rules they'll be able to reach back and claw back from as early as May. So that'll be interesting to see. In Trump's first term, they did 14 CRAs. And there's folks that have said he can get 100 in this term. That feels high to me, but I know that, again, the Trump administration learned a lot from the first time around. And one of the things I do get a sense of in talking to folks is that the ground teams at each of the various agencies, or what they call landing teams, that go in and work with these agencies and really start to kind of focus on any given area, are further ahead. They've been spending more time on it. And so the idea would be that day one, day zero, you're really able to get things moving in terms of supporting Congress to repeal certain rules. It's obviously sort of an organizational process to know what you're going after and when. I think that process will run smoother this time. So again, I think 100 feels high, but that doesn't mean they won't get much more than 14. And that's one of the things that was really interesting about this election, and that certainly we at the Federal Home Loan Banks are an example of, is that in the absence of congressional action, when we have such gridlock, we often sort of end up defaulting to regulation through authority or regulation through the different bureaucracies, not just in financial services, but all industries. And so in the moment and at the time, it can feel very burdensome to have to feel like you are changing things overnight that have been a certain way for a very long time, or that normally would have been subject to congressional action. Those were changing overnight. It was very concerning to folks. And again, we're a good example. A lot of things could have changed for us for the worse or for the better overnight. But the flip side of that is it's very easy to uninstall sometimes as well. And rulemaking through an agency is not ever going to be as durable as a statute. And so that's one thing you can absolutely plan on, is some CRA in early 2025 and really throughout until that window of time runs out on the new administration. Second known, you've got the House Financial Services Committee. That chairman hasn't been picked yet or elected. That will take place the first week of December. And while we don't know exactly who it is, there really isn't much light between each of the main contenders in that race. And I think House Republicans have broadly always been pretty unified on directionally where they're going to head. So I think you can expect, obviously you've read about crypto and how there's going to be sustained focus on crypto, and part of that's driven by the administration. But if anybody watched the House Financial Services hearing yesterday that took place, it was markedly different than anything you've seen. You had the heads of all the regulatory agencies brought in, taken to task, very direct, very confrontational. And that's going to continue because not all of those regulators are going to have to leave on day one. And so there's going to be some back and forth. So I think House Financial Services Committee, as well as the Senate Banking Committee, obviously are going to focus on that regulatory oversight and try to determine not only what they can uninstall, but also what they're going to expect of the agencies and what they're going to press the agencies on. So that'll be something early on that you can anticipate we'll definitely be seeing. And there's pretty good evidence from, French Hill was one of the candidates. Now there's some sense that he's sort of, I think for a long time was the leader of the pack, but maybe has started to fall off. And there's been some developments in the last even day that would indicate that. Andy Barr, Frank Lucas from Oklahoma is in the running as well. So I'll be very curious to see how that shakes out. But I think any of those candidates are going to broadly have the same views. And you can read quite a bit about where they're planning to take the committee. And keep in mind, the House Financial Services Committee also has subcommittees that hold jurisdiction over various areas across the financial services industry. So we'll be curious to see who ends up in those chairmanships as well. We know, again, that we're going to have major tax policy. The 2017 TCJA, Tax Cuts and Jobs Act, has to be renewed. And if it is renewed, that's going to be expensive. There's no question. So there's got to be pay-fors. And when you get into theoretical pay-fors, that's a conversation that can run away very quickly. You may have read privatizing Fannie and Freddie right out of the chute is one of the ideas that you could use to be a pay-for in a tax plan. Again, if you go back to 2016, though, immediately privatizing Fannie and Freddie was one of the first things the administration said they were going to do. And you recall Mr. Mnuchin was an expert in this, and it wasn't going to take long, and it was a foregone conclusion, and it never happened. Now, obviously, the back half of Trump's first administration got a little bit sidetracked with a number of things, not the least of which was COVID. So that's not to say they haven't spent the time in between retooling and thinking about how they want to go about it. And obviously, there's been a lot of commentary on a concept like that, but it remains to be seen whether or not a number of these things that get talked about now as a foregone conclusion are really going to come to pass. It's much more difficult politically. And again, Fannie and Freddie and recap and release is a good example of something where it's easy to talk about. It looks good on paper, but when you really get into the politics of it, you're talking about a third of the economy and essentially unplugging a big portion of it and trying to get it plugged back in on a 2-year cycle. Those House members that just got elected are going to be less enthusiastic. And again, it's a tight margin in the House about unplugging something that critical to the economy and then trying to get it plugged back in. So just a good example of don't always presume that the headline you're reading or that whatever the administration may stake out as a first line priority is an automatic. We've talked about regulatory showdowns. Transportation spending will be interesting as well. You've got billions that are sitting on the table still, billions in 25 and 26 spending that'll be spent. And I like the way somebody that I was listening to would put it, and they said, think less urban bike lanes, more rural bridges. So as Drew noted, and is absolutely true, spending is indeed a bipartisan issue at this point. It doesn't seem that either party is too interested or concerned with the deficit. Of course, Trump uses the argument that the tariffs and a stronger economic policy will, over time, draw down that deficit. Well, that remains to be seen. And then I also noticed in the poll question that housing affordability is a big key. That's another one where infrastructure has something to do with that. And the labor and jobs market is a big issue. I think, for us, one of our observations is obviously with affordable housing that supply is a massive issue. And so depending upon how deep you go on immigration, that obviously is going to have an impact on the labor force and by extension, the supply force. So that might be another example where you don't take them literally, but you do take them seriously. So that'll be interesting to see how it plays out. And I think we'll have a massive impact on where we go on housing affordability, because we really do believe you've got to get more supply. So as far as known unknowns, we're getting a little short on time, but I do want to bring up just a couple real quickly. Obviously, DOGE, the DOGE agency, I guess the way you put it, is obviously unprecedented. Nobody knows exactly what they're going to do or what that looks like. If you have federal workers at agencies that are willing to cooperate with them, that could be a difficult proposition for some of these agencies. I also think it's pretty clear from what you've seen already introduced that the Trump administration plans to set conditions such that there's a number of federal employees that say, no, I'm not coming into work full time. And they say, fantastic, we'll show you out. And so part of this, again, is the gamesmanship of just trying to set conditions such that you don't have to make all these changes through the stroke of a pen or through actually doing anything. Part of it is the argument that you make in setting up a circumstance. So I expect that to continue. I think the OMB will work pretty closely with the DOGE, and we'll see what comes out of that. But it also, again, concluding point here, underscores something that I think is really difficult for everybody to grasp. And I'll be curious to see how Democrats respond to this, but Republicans as well. And that's that Trump has, from day one, been very committed to going and finding voters and constituencies and political identities that Republicans traditionally haven't. And I think it's useful if you're trying to figure out where we're heading to go back and look at some of the policies J.D. Vance has worked on in the last couple of years. I think he's a good example of what you can kind of expect in what the new Republican looks like or what that new majority looks like. And it's going to be more worker focused. It's all, some of the presumptions you might make about the things Republicans are going to reflexively support or the things that this administration might reflexively support. I could see that changing. I think they're going to be more worker focused and a little more obviously populist to a degree. And will the Democrats look at what happened this year and decide, okay, well, we've got to make changes of our own. We're going to get some of those voters back. We're going to get those voters re-energized. Or do they attribute it to something that doesn't have anything to do with their party identity or the strategies that were employed? So those kind of things we can't predict. But I do think as you try to get a bead on where things are headed, it's really important to understand that they're aiming at a little different spot than they have. A lot of it will ring true, but a lot of this is going to be different. You've also got an administration that, as you try to predict who's going to land where, loyalty is key. I've read a lot of analysis that tries to factor in, again, to me, sort of legacy considerations about, well, this person's got a background here and they've got more experience in this. And sometimes it's just as simple as it comes down to loyalty. Now, for Treasury, for some of those bigger roles, maybe that doesn't hold true. Maybe he's willing to be a little tighter than he was with some of the initial ones. And again, some of the initial ones could have been cover fire or performative to a degree. So that remains to be seen. But either way, the economic agenda is still going to be murky for a while. I think they want to get this right. I think they want to prove that they can govern, but that's, again, easier said than done. And some of those margins in the House are small. I know the Speaker has talked to the President about not taking any more House members to the cabinet because those members all have to be replaced, and the margins are thin right now. There was even a discussion that the Republicans could temporarily fall out of the majority. I think that's a little outlandish, but when everything's on the line, crazy things happen. So this will be obviously an interesting cycle, but I think for the most part, I'll take the FHFA as an example. We would expect that the base case for a change in an agency is you'll have somebody installed. That landing team will have somebody installed as an initial appointment or a temporary appointment. And, your average confirmation process is going to take probably 6 months in a lot of cases. So you're looking at July, August before a lot of new regulators are actually installed. And of course, in the meantime, all those different rules and regs and that CRA process and those types of things will be working. So by the time you really get down to brass tacks policies or brass tacks legislation moving, you're into Q3 next year. So just for a sense of timing, that's kind of where we're coming at it from in terms of our planning. And of course, all of that presumes that there's not an unknown, which would be a foreign war or an escalation in conflicts that are already taking place. So you always have to plan for those types of things, but you don't know what they are. You don't know when they're going to hit. But with the greatest degree of certainty we can, we're trying to stay ahead of it on behalf of our members. And certainly, if you've got questions, feel free to hit us up. You know where to find us, and appreciate everybody's participation today. And with that, I will turn it back over to you.
Okay. Appreciate it, Ryan. I know everybody was highly anticipating your remarks there, and those are certainly helpful for our members. It's interesting because going forward, I don't think it was lost on anyone that just because of the results of the election, what the Fed does next, that we'd all of a sudden just be in this very certain world moving forward. So uncertain is the name of the game, with an eye on kind of putting one foot in front of the other, looking at the past, looking at prior trends, what worked, what didn't work. We're having active conversations with all of you guys, so don't hesitate to reach out. You want to see what other trends that you're seeing, maybe more locally in your area. Your rep can definitely provide some specific peer numbers for you. We've heard some complaints recently about the increase in S&P's pricing, right? And so we've been hearing a lot about that. It was already a very expensive service. So for them to increase pricing again has unfortunately forced some of our members not to use that anymore. So if you're in that camp, or if you just don't use S&P at all and want to look at some of those peer figures that they put out, we're happy to do that for you. Yeah. And I think in this talk about uncertainty when it comes to pricing and best practices, and we just wrapped up a very intentional conversation we have with some of our C-suite members, and got some great feedback as to what they're doing. These are, many of these folks are, competitors with each other, and yet it was a very healthy conversation to talk about, what they thought would work best, what's been working, and healthy discussion. So we'll continue to have those discussions with you guys. But again, if that peer analysis is something that you're interested in, don't hesitate to reach out, and we'll definitely help you out. I'm just going to quickly wrap up here, guys, with sorry, I accidentally muted myself. Maybe that's fate. You don't want to hear from me anymore. I get it. So just as an update, because as we move into the first part of the year, that's really when you're starting going to hear a lot of communications from us regarding these programs, our affordable housing program, our turnkey programs, the community housing and development programs, and our Native American housing initiative. So just keep your ear to the ground. We'll try to communicate to everyone as quickly as we can as to the important dates that'll come up when it comes to registrations and signups and all that. Nahi's been a huge success. We rolled it out initially in 2023. This is our Native American housing initiative with funding to the tune of about $1 million. Ended up awarding $3 million. And then in this year, we bumped up the commitment to $3.6 million, and are happy to report that we awarded well over $5.3 million. So thank you to everyone who's been participating in that. It's been a huge help to much underserved communities. We're getting a lot of feedback from you guys of how important this is to your local Native American customers, as well as just the tribes as a whole. This is an area, especially for my folks here in Oklahoma, a much needed underserved area. So congrats to everyone who received an award this year. That $5.3 million was spread across 12 different recipients. We had 2 in Colorado. Don't believe we've had Colorado before. So welcome to the fold, Colorado. That's great news. 4 awards in Kansas, 1 award in Nebraska, and 5 in Oklahoma. So you can see over here to your right, and again, we'll share these slides with you. Feel free to reach out to some of your peers and ask them about the project. We try to tell a lot of these stories as we move on through the year, these success stories, and how impactful it was for these local communities. So congrats to all the participants. If you have any questions regarding the process or anything like that, this will be one of the last things that we wrap up next year. I think June.
In terms of timing, June is when the application process will open, and it will close in July.
Yeah. So keep your ear to the ground for that, because this is free money that goes to a great place, and certainly folks that need it. Turnkey for 2025. This is our new branding of just the umbrella and the suite of products that we have when it comes to down payment assistance programs and such. So be on the lookout. January and February is when we start doing those announcements. The board has approved our implementation plan and targeted community lending plan. That'll be published in early January, and it'll include all the rules of those within that program. When you get these slides, or if you can live, I'm not sure, I believe you can live because my cursor is changing to a little hand there. You can click on that turnkey resources link and see all of the information there. So feel free to do that. If you have any problems accessing it, just don't hesitate to let us know. Other than that, really appreciate everyone's time today. We're here to help. Times are a-changing. We are moving into some version of a new rate cycle. That's clear. We've already had a couple of cuts under our belt, and we'll see where we go from here. But these are the times where it's really important to make sure we button up our strategies. We button up, what our anticipation is going forward. How is it going to impact us? Do we need to make any changes? All those things are certainly part of sort of changing in the cyclicality of these markets. So keep an eye out for that, and we'll have those conversations with you. Also, keep an eye out for our upcoming events. We just wrapped up all of our regional meetings, so thanks for attending to those in your specific state. Had great attendance there. The next big one will be our annual member conference, which will be held in Wichita, Kansas, so a little closer to my Oklahoma folks, a little easier drive. But that will be April 16th through the 18th at the Hyatt Regency there in Wichita. So looking forward to that. We got already a great slate of speakers, great fun events, good golf track that we'll be out there playing on, and always a good time. We always really enjoy seeing everybody from all 4 of our states and our districts. So keep an eye out for that. Register. Encourage the rest of maybe some of your colleagues at the bank that might benefit. We cover the gamut, everything that we do. We'll share member trends. We'll talk about the economy, a little bit of everything. It's always a good turnout at that event. So be sure to try and attend this year. And with that wraps up our presentation. We got our contacts here for you. If you need to reach out to your regional managers, they're on the left, myself, as well as Tony Mendetti in Nebraska, Jeff Steiner in Kansas, and Rusty Davis in the great state of Colorado. Our general lending and wire service contact information, housing and community development, all that, MPF. Those contact numbers are there to the right, so don't hesitate to reach out to us. We are entering the holidays, so I want to preemptively wish everyone a happy holidays, and hopefully the year went great for you. We are looking forward to next year, and with that, we will go ahead and wrap up the call. Appreciate everybody's time.